welcome. Thank you for joining us for this great panel discussion today. From Seed to Scale, Exploring the Fundraising Journey, in partnership with Michigan Central, Ford, and Bamboo Detroit. Before we get started, we have a few housekeeping items to take care of. Please take a look at our community statement in the chat. We look forward to engaging with everyone in this conversation through our chat and Q&A functions through Zoom, but let's make sure we do so respectfully. To get a better sense of who's in the audience today, we're going to do a quick poll. Please let our panelists know, and the rest of the audience, whether you're a startup entrepreneur, investor, interested community member. We'd also love to hear from you directly in today's session. Please feel free to jump into our chat, say hello, introduce yourself, maybe share your name and where you're calling in from today. We will also be running through our discussion points with our moderator and panelists to kick us off. At the second half of the event, we will be opening it to audience Q&A. So be sure to submit your questions in the Q&A function or through chat, and we'll get to them when the time comes. All right, poll is closed, and it looks like we have a majority of our entrepreneurs and startups with us today. So thanks so much for joining us. Moderating today's panel, we have Roshini Shokar. She leads the startup and entrepreneur engagement for Ford's Michigan Central development. She has a background in marketing and business strategy and has experience working with both startups and large companies. She's been based out of Detroit since 2017, working in the mobility industry. She is passionate about growing the entrepreneurial scene here locally and across the country. So this is a great discussion for her to lead today. Roshini earned her MBA from the Kellogg School of Management, where she focused on entrepreneurship and social impact. Welcome, Roshini.
Thank you so much, Allison. And thank you to the full Bamboo team for helping us pull this together today. We really appreciate it. I'm really excited today to have three excellent speakers in the startup and the venture capital space. And so if Patty, Chris, and Kyle, if you guys want to all hop on and introduce yourselves, I'm really excited to get this started. So Chris, why don't we start with you?
Yeah, good afternoon, everybody, and thanks for having me here. Really excited about this panel. I'm Chris Tallman. I'm one of the partners with Fontinalis Partners. We're an early stage venture capital firm focused on investing in mobility companies. I'm working out of my home these days, but the background behind me is our office in the One Woodward building in Detroit, right in front of Hart Plaza. So feel free to come visit us when we get back to kind of things as normal.
Great. Thanks, Chris. Patty, why don't you go next?
Hi, everyone. I'm Patty Glaza. I'm a managing director at Invest Detroit Ventures. We are the most active pre-seed and seed funder here in the state of Michigan.
Awesome. And Kyle, why don't you finish it off?
Hi, everyone. So first of all, shout out to whoever was controlling the music in the waiting room. The instrumental from Passion Fruit, that's a deep cut for a pre-panel soundtrack. So appreciate that. That was quite good. I'm Kyle, co-founder and CEO of ClearCover. ClearCover is a next generation car insurance company. We use technology to lower our costs so we can offer people better products, better experiences, and lower prices all at the same time. We are about 425 or so employees, give or take. We're based out of Chicago, but we actually have a decent presence in Michigan and in the Detroit area, where we have some call center and claims operations.
Great, thanks. And then to kick it off, we'd love to hear from all of you on how you got to where you are today. I know we have a lot of entrepreneurs and investors in the audience. So Kyle, why don't you start us off? How did you become a successful startup founder?
The successful part of that sentence is still up for debate. This journey is far from over.
The tough one.
This is the long way left to go. So very quick. I won't monologue for too long. But I got a law degree and an MBA. I was an attorney briefly working with startups. And then in 2012, I joined American Family Insurance out of Madison to help start their venture team. And over the course of 4 years or so, we had, we had about 200 million or so under management by the time I had left. We were doing a bunch of early stage deals. But, I found that venture capitalists and entrepreneurs are a little like athletes and rappers in the way that they both think they can do each other's jobs a lot. And occasionally you see some crossover. Sometimes that crossover works, sometimes it doesn't. Like I just got itchy listening to folks building companies and wondering if you could do it yourself and like wondering if you could make that leap. And so in 2016, left American Family to officially start ClearCover, and that was just about, it was early November of 2016, so just about 5 years ago.
That's awesome. Patty, how about you? How did you become an early stage investor?
Yeah, so I've had a very kind of windy career path over the past 30 years. So I would say, I've just always have followed my love of technology and how to make the world a better place with it. So I would say, having led two startups, mixed success, I really developed a passion for helping build foundations, which ultimately led me to Invest Detroit. I'm not an expert at scaling by any means, but after investing in over 100 companies now to date, I'm really good at the early focus, customer acquisition, founding teams, and just building the blocks that will help a company scale as they go forward.
That's great. Looking forward to diving into that a little bit more. But first, Chris, how did you get to where you are today?
Yeah, I'd say kind of where I'm at today is a little bit of a progression of some early experiences I was very fortunate to have. During my undergrad days, I built a couple Web 1.0 businesses, nothing tremendously large, but enough to kind of pay my way through my undergrad days, and also at the same time give me an interesting early exposure to concepts like customer acquisition costs and total lifetime value and all these concepts that are so kind of well recognized today. I also had an opportunity to spend a year working with the University of Michigan's endowment, which was an early investor in many venture funds out there, and seeing kind of directly how a lot of professional VCs did things. And then I spent the next 5 years after that doing transaction advisory work. Many of our clients were large automotive companies, large tier ones. So a lot of sector exposure that then became relevant later on as I became a mobility investor overall. And 10 years ago, I met the founding team at Fontinalis Partners and heard their ambitious view of building a venture firm, kind of unlike a lot of other venture firms at the time, and being very focused on this theme, and have been a part of the group ever since, as we've built out the firm.
Wow, really cool. So Patty, you mentioned that you have gotten really good at funding those early stage startups. And I mean, that's such a hard, phase to gauge, because a lot of times the startups don't have much traction yet. So what do you look for? How do you figure out, who's going to be the next big company?
Yeah, we do operate with very little information at the stage we're working with. I would say, though, we do really start by looking at what a company or what a team has executed to date, if it's just a few things. I want to know that the team are fast learners and they can adapt. One of the critical things that early stage companies have to do is, as they learn about kind of their customers, or they hear how the market is shifting, being able to adapt. So we're listening to what have they executed, what have they learned, how has that changed sort of their path to date. We do want to make sure they understand their market. Often we have founders who don't truly deeply understand who their customers are, what the dynamics of the marketplace are. So if we can hear and understand them talk in the voice of the customer, it really can set them apart. We want them to be passionate, but not necessarily blinded by their vision. So again, being able to see the forest through the trees. And we're looking for founders who can overcome obstacles, because, as Kyle even kind of said, it's a hard journey. And so, we often see folks who come in and they talk about, all the things all the reasons why they're not to be blamed for why their company isn't farther ahead. But that's not what we want to hear. We just want to hear what obstacles have you met and how did you get past them, so that we know that going forward, when they hit hard patches, they're going to be able to keep going. So I would say the last piece of advice I would give is build, or what we're looking for is somebody who's been able to build a strong informal team and advisors, because that sort of shows their ability to sell their vision and attract good people. Because at some point they're going to need to build big teams and going to need to attract really big talent. So informally, we want to see who have they brought into their circle at the early stage.
Yeah, I agree. That's really important. Do you typically look for a company that has more than one founder, or do you ever fund solo entrepreneurs as well?
So we do have a new program that we're calling the FAM Fund, in which we are funding solo entrepreneurs with very small amounts of funding in order to get enough traction to be able to start to build a team. But really the majority of our work, it has to be at least 2 people. I think the majority of the companies we fund tend to be in the 3 or 4-ish range, not all full time, but at least are starting to informally build out the go forward team once they have enough traction and capital.
Okay, cool. And then Chris, your team at Fontinalis is kind of, that next stage of funding once the company's proven themselves a bit and they're looking more for Series A, Series B round. So what are some of the indicators that you look for that a company is ready for the next stage?
Yeah, and we do some seed investing as well. I think the notion of what all these rounds are is somewhat morphing and shifting these days as it is, but still largely focused on Series A and some Series B opportunities. And I think when we look at companies at those stages, we're generally looking at companies both on sort of the hard qualities and characteristics, as well as some of the more, softer qualitative aspects. And, I think we certainly do care about things like, revenue and various KPIs along the way. But at the end of the day, what gets us excited and what really gives us the conviction to build a 5 or 10-year relationship with a company, because that's how we think of things. We think of it as really trying to build towards a long-term relationship. We're seeking companies that are really starting to find their own identity. They're starting to kind of know where they fit in their ecosystems. Are they a product company? Are they a services company? What are the best use cases they're solving for? Who are their target customers and segments, and sort of the initial ideas when that business was launched start to kind of figure out a little bit more firm footing in some of these segments. Kind of touching on a point that Patty mentioned around sort of the attraction of talent. Some of the most important signals for us are just, is that gravitational pull of that business getting stronger over time? Are they increasingly attracting impressive talent, advisors, surrounding themselves with key partners and everything in the ecosystem overall? When I think of attraction of talent as a signal, there's investing capital in a company, but there's also really investing your time, and time is the most precious thing that you have. And then, dedicating your career and your efforts and your resources to a company is a very significant one. And so for us, we really like to see those companies that just are able to fill out their bench, everybody from the technical and engineering team to the senior business development team, sales team, everything along the lines of just really great individuals that can take this company to the next level. And usually at those stage, of course, product market fit is coming into view, even if it's not fully there yet. There's a semblance of it kind of emerging through the weeds, if you will.
Okay, great. And Chris, Fontinalis, I know, has a mobility focus. How does that cause your approach to be different when you're looking at companies, or does that cause the stage companies are in to be different, or how does that impact?
Yeah, a little bit. So as part of our mobility focus, we take a very broad view of what mobility is. In fact, we include enabling technologies that we think are necessary to push the space forward, and that could be semiconductors or AI and machine learning. And so a few of my partners that focus on some of more of our deep tech investments, they may not hit the same milestones at the same funding stages that other businesses. Obviously, an enterprise software company might have certain milestones earlier in its life cycle than a advanced materials company, is just one example. And so we do have to sort of calibrate our expectations, but some of those aspects of gravitational pull, talent attraction, those tend to be pretty common across all of our portfolio companies.
Okay, great. Kyle, I'd love to hear from you as well. What I know ClearCover has raised a significant amount of capital. Was raising venture capital always the plan? Did you guys ever explore other growth models like crowdfunding or raising other types of funding?
Raising venture capital was always the plan. You know, this, not to get too far into the weeds, but the business model of insurance, particular personal lines insurance and auto insurance, necessarily requires it to grow quickly. The margin profile, the finances of the business just wouldn't support a bootstrapped approach to growing the company. So we knew from the outset we were going to have to raise money, and a lot of it to try and build this business. But not everyone has to. I think, you know, we went in eyes wide open about the business we were choosing and what that implied about our capital path and the amount of capital we have to raise and what it meant for how we ran the business. We have taken on debt as well. So we've raised about 330 million in equity. We've raised 50-ish million in debt or so over our lifetime. And then we've looked at some more non-traditional stuff. The debt has taken on a couple of different forms. ICOs were super big when we were like a Series A company. So we only like lightly and over drinks entertained the idea of doing an initial coin offering. Now it actually seems a lot smarter than it did back then. But really, you know, traditional startup financing sources, venture money, venture debt, some structured debt, but that's about it.
Okay, and how was it when you went out to raise funding, raise your first round? Did you run into any challenges? Did you already have relationships? How did you go about that?
Oh, raising money sucks. It's the worst. And it's really hard. And we cheated because I used to be a venture investor. So I had a bunch of friends I could call and who I had already told about the business. And we had a pretty non-traditional funding path. So we came from American Family, who like didn't spin us out, but were our first supporter. So when we left, they led our seed round of $2 million and they were the only investor in it. So they gave us $2 million on our way out the door and said, off you go, good luck. We raised our Series A like 6 months after that, because the 2 million would have taken us far, but not as far as we wanted to go. And so we raised the Series A after that. And that process was abbreviated. We talked to maybe 6 or 8 people that I was very close with. And, you know, 7 of them said, hell no, absolutely not. And one of them in Chicago, Vic Pascucci with LifeBank was like, sure, I'll bite. So that was like not a real process. And then since then, it's been a combination of like very real processes where we pitch a ton of people in a short window of time and you get a lot of no's and you hopefully get one yes. And like our Series C, we raised on the back of a memo with like some appendix slides with metrics in it. And we just told people we weren't actually raising, but we had written this memo anyways, which was totally a lie, but at the time it didn't seem like a lie. And that ended up turning into a round. So it was kind of a mix of like very intentional processes, not so intentional processes, but they all suck. They're all, none of them, they're a necessary part of the journey if you have to raise money as a startup, but they're not particularly enjoyable.
Yeah. Do you feel like it got easier in those later rounds, or there's new challenges?
No, it never got easier for us. It gets easier for some folks. Our business got harder and more complex as we got bigger. So the level of difficulty remained the same. What was difficult about raising changed. Like the dynamics of the difficulty were changing over time, but like the degree of difficulty of getting the money closed hasn't changed much for us over 4 or 5 rounds now. That's kind of a disheartening thing to hear as an entrepreneur. Sorry,
yeah.
it is. Theoretically, it's supposed to get easier. It just doesn't for everybody. It depends on your business, I think.
Yeah, got it. Patty, how do you guys work with some of those seed stage companies when they're ready for their next round? How do you kind of help them get there and help them identify it's time to raise another round?
Yeah, I would say the majority of our portfolio support is around this topic and helping founders here. I think if there are any founders of mine in the audience, my favorite phrase is, "You never stop fundraising." It's just a continual job. You don't get to fundraise and then put it aside and do the job of running the company. You always have to be thinking about the who's next. And people would be surprised, even before we invest, we're talking with our companies about what relationships are you building with the next round investors. And they're not formal relationships, but we want you to be hearing what metrics you need to be aiming for. Now, those metrics can shift or change, and that can be frustrating to entrepreneurs, but at least starting to have and build those relationships to understand what metrics are going to be important. A fundamental equation that we often are spending a lot of time with founders on is how to manage your cash to get enough traction and velocity to make yourself interesting for the next stage. And for some businesses like Kyle's, it could be 6 months, it could be 2 years. And so as you're managing cash and trying to build the velocity of the business. Now, I want to emphasize velocity because we often hear targets of, hey, you need to be at 500,000 or 1 million to get interest for a seed or Series A. But the speed at which you get there is also really important as part of that equation. So if you're slower to get there, it may be harder to get capital. And so trying to help folks manage that equation of the cash to hitting the metrics they're going to need and being able to prepare them for those conversations with that next stage, which hopefully, again, they're already building those relationships, but really be able to say, okay, we're going to be raising in 6 months, and hopefully similar to Kyle, you have that someone say, hey, well, I'll give you a check now. And those runs come together faster, but it's a hard balance. Fundraising is hard and it sucks. And just for everybody to know, as VCs, we have to fundraise too. So we're not just sitting on one side of the table. We also have to fundraise for our own funds. So we can empathize.
Right. Yeah, that sounds pretty hands-on. Do you guys work very closely with your portfolio companies, or what's that relationship like?
Yeah, it's certainly gotten harder. So when we had a portfolio of 20 or 30 companies, it was much easier. Now we're managing over 100 active companies in our portfolio. We did bring on a dedicated entrepreneur / angel investor, Jeff Ponders, to really be our kind of funnel of support. So, hey, he can help you, or you can get to help, we can identify at what stage we can be most helpful, but it is hard because fundraising takes time. We're building as a team. There are 7 of us now, always continuing to build out our network so that as our companies are approaching that next round, we know different folks or folks in their vertical or with different specialties, we're able to make those early intros. So we're working really hard behind the scenes to try to ease that process for our founders.
Mm-hmm. And does that relationship typically continue as founders move into later stages, like Series A, Series B, or once they kind of start to grow, then they don't really need like your specific support as much?
Yeah, I think it really depends. The majority, once they hit the Series A, typically are well supported by a couple strong Series A investors. But if they're moving through still with kind of maybe a strong angel networks, or they're not, they don't have as strong lead investors as others, we will stay and continue to help. At the end of the day, any founder that we've invested in can call me or text me and I'll pick up the phone and try to help. I would just say that our ability to help, though, decreases as the companies get past really the Series B stage and are moving into areas that we don't have as much expertise.
Mm-hmm. Great, thanks. Another topic in funding that we kind of started to chat about, Kyle, but I'm curious to hear each of your perspectives on. I feel like we've been hearing a lot of different funding trends, especially in the mobility space of, companies using SPACs in order to go public, things like that. Chris, could you talk to us a little bit about some of these trends that you're seeing and what's kind of standing out to you?
Yeah, I mean, there's been tremendous investment generally in the mobility space, and it's continued to be a theme that's attracted a lot of capital. The SPAC market and the SPAC mechanism was an interesting moment. A year ago, it seemed like every company out there was fielding multiple SPAC opportunities, and several of them took it, and several of them, subsequently went through that process and de-SPACed. I think a lot of the air has come out of some of that, but a few of the areas that have seen a lot of activity on that front continue to see a lot of financing activity in the private market. So electric vehicles certainly is a theme right now that continues to be extremely active for venture financing. We see it all the time. I think a little bit of air has come out in some of the public sector names recently, but hasn't necessarily been reflected in the Series A and Series B rounds that we look at today. And it's interesting because this isn't necessarily an entirely new theme. We sort of saw the clean tech wave of the early 2000s fizzle out. It was a very different time period then, very different economics. And now we have a little bit more tailwinds behind this space, larger commitments by the OEMs, more of a focus on a US supply chain at the moment. So there's all these other aspects that I think right now are creating signals to entrepreneurs to kind of build in this segment. And it's not the only segment that's kind of caught a lot of national attention. I think every company is going through supply chain disruptions right now. And I think that's put a big focus on one of the biggest operational areas of many industries in that managing of their own supply chain. So the companies that exist in this segment, in which we also invest in this segment, have attracted a lot of capital in the last couple of years. Other areas like space tech, has kind of come more into vogue in recent years. Automation in general has been kind of a continuous theme. I think a few segments like AV technology have maybe come to the realization that it's going to take a lot more capital and time than folks initially realized. And some very large incumbents have kind of entrenched themselves in some of those segments and have, fallen a little bit out of favor amongst the venture community overall. But I do think that this is a segment overall that probably does have the ability to continue attracting capital. But it's not the case that every company gets it. And when we see these stories of these large funding rounds, there's still a lot of companies that still struggle to raise capital at early stages. And sometimes we see that in Michigan, where there's a little bit less of a built out angel community, and there's not enough Patty Glazas out there to fund every single company and idea. But I think in general, the abundance of capital has really emerged over the last 2 years, and I think is probably likely to continue going forward in some of these themes.
Mm-hmm. Yeah, kind of on that note of entrepreneurs struggling to raise funding, we had a really good question in the Q&A. Can you speak to places that marginalized entrepreneurs can look to? I think specifically with founders of color and the LGBT community, it's a lot tougher to raise funding. So any advice there or any progress you've seen in that space?
Yeah, I think it's an absolute accurate observation of what's going on, and it's existed for a really long time, and I'd love for it to be fixed overnight. One area that does give me a degree of optimism is that, as Patty mentioned, funds, venture managers, we have to go out and fundraise ourselves. This is a topic that very much has become central to limited partners, especially institutional limited partners. And that's placing more pressure right now on venture investors to make sure that there is a very inclusive approach to all segments, if you will. And I think what we've seen in the meantime, though, is also an emergence of a handful of dedicated funds that I think, in recognizing that the rest of venture hasn't fully come around overall in quite the volume that it should, have stepped in to serve this market and really find great opportunities with some really great founders that might otherwise be overlooked by the traditional kind of venture approach, if you will. I think over time, venture investors that are not looking at many of these marginalized community founders are ultimately going to fall behind, because I think innovation, great ideas come from everywhere, and oftentimes it's those segments that maybe don't fit into a perfect box amongst venture investors that have the biggest outsized returns.
Great, thanks. Patty or Kyle, do either of you have anything to add there on, advice for founders?
So I agree with Chris. There are certainly a sets of funds that are now dedicated to underrepresented, marginalized, inclusive. We have one, the FAM program. We also, though I would say our funds have over 50% women, minority, immigrant founders. So we've been intentional about this for the past decade, have seeing the opportunities with founders not coming sort of through the traditional mirror lens that we see. If you're a woman or minority, let's be honest, it's probably going to take, in many cases, 2 to 3 times the amount of time to raise half the amount of capital. It's getting better, as Chris said. There's more attention to it. I do think as venture funds, and I do see a good commitment to it in the venture capital world of diversifying our teams, right? If our teams aren't diverse, it's harder for us to operate, generate trust, and find the opportunities that really are out there. So we have to be, our teams have to reflect the communities that we want to invest in. But it is, the eyes are opening, but it's still going to be a harder effort. I would say just build relationships and advisors that can help you navigate not to put Kyle under the bus here, but the Kyles, right, who have experienced sort of both sides of the table, and finding the folks who have the relationships that can make the warm introductions if possible. But again, I do see a lot of change starting to bubble up, but it does take time. This isn't an overnight fix, and it'll be years before I think there's true equity in the space.
Absolutely. Great. Well, thanks for that. So one topic we've also skirted around a bit is that capital has become a lot more readily available these days. Do you see typical funding rounds shifting up in size, or do you see rounds happening more quickly because of that? And that's open for anyone who wants to jump in.
I've seen rounds, bigger checks and going faster. Now it's not for every company, but if you have that velocity and you have like a good traction, what we're starting to see is A round investors starting to go, hey, there's too much competition at the A. I have to come a little earlier into the late seed in order to get into a deal. So we're seeing people wanting to write bigger checks. So but I've seen this cycle over the years a few times now, so I don't think this is brand new. It's just sort of cyclical to VC. When there's a lot of capital that needs to be invested, and we're kind of in that space right now, a lot of money was raised, a lot of money needs to be deployed, so people want to write bigger checks and to see their checks grow companies faster, right, to execute faster if possible. So we are seeing right now certainly much bigger rounds and usually coming together a lot faster than historically.
Yeah, I would just echo that too. I mean, we're seeing the same thing, and several of our companies this year have gone to market to raise capital very quickly. They've put together, essentially receiving term sheets in their first week of financing activities for their next round. And I don't think we were seeing that really a couple of years ago. And so in many ways, moving quickly is kind of table stakes for venture investors these days. We're encouraging a lot of our portfolio companies, I think this was touched on before, we're encouraging a lot of them to always be fundraising as well. I sit on the board of a company where two members of the leadership team, one Friday a month for a couple hours, they just schedule all their investor calls when they're not fundraising, just to maintain those relationships. And our last round, we never went out for capital. It's one of those parties we met in one of those discussions, preempted a round and put a term sheet in front of the company, and it was compelling, and we agreed to it. And so we're seeing a lot of those where financings are getting done without real structured financing processes. And as venture investors, we ask ourselves, well, how do we compete in that ecosystem or in that dynamic? And one of the advantages I think our firm had is that being focused on mobility early on and building 10 years plus of relationships, we get to know some of these teams before they've actually sometimes even spun out. So we've actually backed as early as a couple of founding team members coming out of Tesla or Uber together, or some of these other companies we've gotten to know. And I think we're going to be doing, more of that, because it's just the nature. There's more strategic investors, there's more family offices, there's more crossover investors. It's not just the traditional venture funds investing in these companies these days. So we have to all look in a mirror and say, well, how are we relevant for the next 5, 10, 20 years? And how do we continue to find great companies and support them?
Mm-hmm.
For you entrepreneurs out there, though, so there's something you have to realize, which is venture capital is a game of cumulative advantage, which is another way of saying it's a game where the rich tend to get richer. So there are two worlds out there, right? You are either one of these companies where this is very easy, and all these stories about how much capital is sloshing around and getting preempted and all this stuff is a reality for you, or you are not one of those companies. And if you are not one of those companies, those stories are useless for you, because you're going to have to fight and scratch and claw and beg and talk to 100 people to get one person to give you 100K so that you can talk to another 100 people and get, right? Like, and great businesses get built that way too. So you just have to understand, like, there's a lot of stuff you're going to read out there about, like, oh, look, here's this Medium article about like how I raised my round without ever talking to an investor. And like, that's fine, good for those companies. Not every company gets to do it. In fact, very few companies end up like that. Most companies are built on like toil and sweat and tears and all the hard stuff behind the scenes, and it just isn't that easy. And it's okay if it's not that easy for you. It's totally okay. We have raised $330 million. I might lose it all. The company might fail. So take that, with a grain of salt. But it was always hard. It was never, even those rounds where we felt like, oh yeah, we wrote a memo and come on, like it almost didn't work, right? So like you should take heart, like this is a game where like there are very much two states of the world. You are a have or a have not, and the have nots have a harder path but can still build really great companies, and you shouldn't be afraid to be in that camp. And if you find yourself in that camp, keep going. It doesn't mean you're not going to win. It just means your path will be a little harder.
Kyle, thanks so much for painting that picture. I think it's really important to see, how real it can be for founders. Do you have any advice for founders who are like kind of stuck in that phase where they feel like they can't even get like, the first like 10 or 15 or 20K, and, like how to keep pushing forward?
It's really hard. You should remember this is what you signed up for. If it were easy, then everyone else would do this, and the spoils would be abundant. I think, I think what people, there are two necessary ingredients to a fundraise happening. And they're quite simple. One is a business, and another is an investor who wants to give money to that business. And people tend to focus almost all of their effort on this one. What is the business I have to build? What's the number? Well, how much ARR do I have to have? What is this milestone or this milestone? And like, that's fine. And those aren't things you should necessarily ignore, but not enough people think about this side, this ingredient in the equation, which is the investor that wants to give your company money. And so I encourage entrepreneurs, spend a lot of time, more time than you might think, playing the person, thinking about what motivates the individual who's going to write you a check, what their incentives are, what they care about. Here's like a quick example, right? So let's say you're talking to somebody who runs $100 million fund, $100 million bucks. And roughly speaking, if they want to be a top quartile fund, which everybody wants to be, they're going to have to turn that 100 million into like $400 million. Again, rough math. So I need $400 million. They're an early stage fund, so they're going to invest pretty early. They'll get diluted down. Let's say on average, they're going to own about 10% of the companies they invest in over the course of like the ones that end up being big. So that investor has to generate $4 billion worth of portfolio value to get $400 million out of the set of investments that they're trying to make. So now they have to generate $4 billion. So where are they in their fund cycle, right? Like how many deals have they made? How are they doing? Are they at the point where like they have to bat 1,000 and like every company's got to be worth 100 million to hit the mark? Are they at a point where like they need a $2 billion outcome to make the number, in which case they might be thinking about what they want to invest in a little differently? Are they the type of person who seeks risk or avoids risk? Are they the type of person who will back a founder with nothing but a deck or need a bunch of proof to do it? And like, I find that people like work on trying to make their company good for everybody and don't spend enough time thinking about who am I talking to? What motivates them? What are their incentives? What are the structures that they operate in? And am I a good fit? Can I match that? If I can't match that, move on, right? You're wasting your time. If you can match that, those are the people that you double and triple down on, prioritize your efforts, focus, because those are the only ones where you really have an opportunity to win.
Yeah. That's great advice. Thanks. Patty or Chris, any last words from you before we hop into audience Q&A?
Maybe I just wanted to touch on Kyle brought up a really good point, which was understanding your investor, and sort of one thing that he touched on was where are they at in their own fund? Because that is an important topic overall. If you are a first investment in a new fund, you've got an investor on the other side that might be more willing to be patient, might be there with you for the long term. You're building to the long term. You want your investor long-term focused as well. That's also an opportunity to have an investor that would be more likely to provide follow-on capital for you if you need a bridge, or to be a pro rata check in your next round or two, and as you're raising capital as well. If there's somebody that's a few years into their fund and maybe it's the last investment or two in that fund, then you're in a situation where maybe that person's going to be distracted with their fundraising. They're going to be distracted with launching their next fund. They're going to be more short-term oriented because they're thinking about the ticking clock of the life cycle of that fund and being able to return capital to their LPs. And these are things that, in a first meeting, you don't really bring all these topics up because it's kind of an odd use of time in that first meeting, but it's things that you should be getting to know about any of your investors as you're having subsequent conversations, because you want to see how they tick and make sure that there is an alignment, especially if they're going to be serving on the board, because they have a fiduciary duty to all shareholders. And you want to make sure that they are building and viewing this business in the same way that you're doing. And if you optimize for just a quick financing round of a couple of days to a term sheet, well, how well do you get to know that person? And that relationship might be for 5 or 10 years thereafter.
That's great advice. Thanks, Chris. We do have a question from the audience. How can you learn where an investor is in their fund? I know you mentioned like through conversations. Is there any other way, or is it really just talking to them about it?
Look, we do this, all investors kind of do this. You trumpet and you announce your fund. And so you can kind of go and find when they announced it. And then most funds have a 5-year investment period. Right now, funds are kind of deploying that much faster overall. I think part of it is just how recently did they announce their latest fund. And if you want to sneak around anymore or try to get more details on it, feel free to shoot me an email. I'll give you a couple other ways to figure that out.
You can ask too. I mean, correct me if I'm wrong, Chris, but like, it wouldn't be the first thing out of my mouth. I would be like, hey, nice to meet you. So where are you in your fund? But like, oftentimes these calls end with like nice people like Chris and Patty saying something like, well, do you have any questions about us? Is there anything about like me or the firm I can help address for you? And like, you shouldn't be afraid to be like, yeah, curious, like where are you at in your fund cycle? Like, and you all will answer, right? You'd be like, oh, we're about half deployed, or we're 3/4 deployed, we're raising another fund. Like, it's not, I think you might get told no, but it's in my opinion, it's not offensive when you get asked to ask the question to say like, hey, where are you at here? It might be important for you to know.
I think 99% of people will be pretty candid, as Kyle says. And
they should be. That's not secret information. So
Yep.
That should be something they're willing to share.
You can also ask questions like, hey, like Chris, what, I was doing some research on your firm. It looks like this company you invested in was like a real breakout success. What did they look like when you first invested? Like, tell me about that deal. How did that deal get done at your firm, right? And like, you can't give all the secrets, but you're going to learn some of it. Chris is like, well, that was kind of a weird, like that company had no traction. We just loved the founder and we were willing to make the bet. And like, that's very rare for us. We don't do that. Like, you never know what kind of information you'll pull out of like a story about the best deal somebody's ever done or the worst deal somebody's ever done. There's information in there that you as an entrepreneur can use to say like, okay, look, I like this person, but that's not enough to like them. Like we have to be a match in terms of our incentives and what we're trying to accomplish and what we both, you know, where we are in terms of their investment motives in my company. And like that stuff is harder to uncover, but not impossible. You just have to ask a little bit of questions.
Yeah, and for every investment I've led at Fontinalis, I've always offered references to any founder that we're talking to and that we're serious with. You know, call other companies we've worked with, including companies that it's been hard, you know, companies where we really had to fight hard to get to where, you know, the business ultimately ended up. You know, we sort of think of it as nothing to hide, just, you know, let you hear it directly from them.
Great. Makes sense. So we have one question in the audience. What is your advice for service-based businesses who are seeking investment? I've been told my business is attractive by other investors. However, they don't invest in service-based businesses.
I can answer that first, and Patty, maybe if you want to chime in too. But service-based businesses are a little bit harder for venture financing. Capital tends to go towards more product-based businesses. We have backed a few services. Sometimes it's marketplace services, which have kind of more of a classical venture model to them. But a lot of times for services businesses, you know, one, proving that it is a service that can be scalable, because a lot of times services businesses have some limitations to scalability of those businesses. The other aspect of it is that, quite honestly, the bar is just exceptionally high from a growth standpoint. So, you know, for us to get really excited about a services business, we have to see growth rates that are probably even higher than, you know, what we see at an early stage product company. Because I think in some ways, you know, when we think about it in sort of a venture construct of an M&A event down the road or an IPO event down the road, we've just seen fewer outcomes in those types of businesses than we have in product-based businesses. But it's not to say that they can't attract venture financing. It's just keep that in mind, that it's important to have a, you know, firm foot on the pedal, a good playbook that works to expand, and some scalability built into the business.
Mm-hmm.
Yeah, and I would say it's one of the few areas we don't invest in at Investor Trade. We do almost everything, but that's one of the few things we don't, for the reasons just articulated. But there are strategics, and there are organizations that are like service partners at service firms that have come together and put together angel funds. And so if you don't need a ton of capital, you know, those are certainly groups to look at, or potentially strategics with funds. But you're going to need to find funds, look harder for the funds that are willing to do service businesses. There are not a ton out there, so you have to look harder for the ones that understand it well enough to invest in.
I would also say, I'm not trying to be an asshole, but you, as an entrepreneur, you have to be keenly aware of when you're being told it's not you, it's me. Like sometimes it's just your business, and it's an easy way for an investor to be like, I don't like your company, or I don't actually believe in you as a founder. And those are really hard things to say as an investor to an entrepreneur. And so oftentimes people will pick something that is also true, but like not the most true thing they could say. Right? Like, oh, I don't like services business. Like, true, but is there something else? That's because like Palantir as a services business is worth $40 billion. And so like, I think you have to make sure you can look at yourself in the mirror and say, did they mean what they said, or was that like a convenient way to pass on the deal? And there's something different that's wrong with my business that I need to go and fix and address to make sure that I don't keep getting that same bit of feedback from folks who actually might invest in a service business.
Great advice. Thanks, Kyle. What are some concrete steps a founder can take to identify and get in touch with lead investors for a Series A round?
Yeah, I mean, some people say they believe in the transitive property of love, which is, if I like somebody and that person introduces me to a company, it's kind of got a little bit more of my attention overall, because I usually that connection point is somebody that knows our firm and kind of knows what we're looking for, and oftentimes they've kind of been a first filter of sorts. So I think building out and having a good orbit of supporters in the organization that do have relationships and connections to different firms can be helpful overall. I also really appreciate when we get just sort of cold inbounds, really thoughtful ones, ones that see connectivity with the way that we've invested in other companies at stages we've invested in, or found other kind of like businesses that maybe aren't competitive. Those at times will sort of draw out our interest, or if they've seen us publish a blog post or something on a topic and realize it's very relevant to their business overall, reaching out to us as a great follow-up. Those are the ones that kind of initially get our attention, because we have what we call kind of a ready mind. We're already thinking about it. We're already looking or thinking about this topic. We're looking for companies in this segment. So we really do want to, meet and talk with those that could be relevant for our strategy.
Great.
I think go ahead. Sorry, Patty.
No, I was just going to add, utilize the investors you're talking to, just like you do in sort of the customer discovery process, where at the end you say, is there other folks I should be talking to? Utilize the investors. Maybe 50 out of the 100 you talk to aren't even close to a fit. But at the end, if you say, hey, I know it's not a fit with your fund, but are there any funds you think this might be worth me reaching out to, or could you make an introduction to? That also can help start to narrow down, the funds that have the right thesis for you.
I agree. I would add not that you all aren't already doing this, but that your process should be systematic. Like the companies that I've been involved with, companies that I've worked with in the past, including our own, when we say, okay, it's time to start doing investor outreach for another round, you first build the list. You say, okay, look, what are the firms that I feel like I want to get in touch with because they have done deals in my space, because they do deals at this stage. These are the folks who I think are going to be a good fit for our organization. Who's the person at that firm that I really feel like I need to get in touch with? Is it the person who runs the firm? Is it the partner who's working on a specific area in the firm? So now I have a list of firms, I have a list of partners, and the next column in that is like, all right, who can get me in touch with that person? And that's where you need to, tap into your seed investor network, tap into other founders, but like the process has to be organized. You got to say like, okay, I need it. How am I going to, who's my best intro to this individual? And in order for that to work, you have to do all of the homework and make the life of the connector really easy. So just like, hey, look, here's an email with a summary you can forward to this person. Like, please, can you sign up to do these 5 people for me? I have a list of 50. I have 10 people. I'm going to sign them each 5. Here's what you got to send them. When you send them, can you let me know so I can follow up? Like, you really got to organize that process and not just be like, oh, can you get me in touch with so-and-so? That'd be great. Because it is going to be, you're going to have to follow up. You're going to have to know who you're getting in touch with. So my advice would be, it is not, serendipity is a big way of, is a big part of how this works, but you cannot rely on it. So you have to build as robust and systematic as a process as you can, which actually increases the odds that something serendipitous and fortunate happens to you along the way.
Kyle, you've raised over $300 million. Are you still looking to raise more? And how do you make the decision of when it's enough?
I'll stop raising money when I stop running out of it. It's no, we're not done raising capital. It's insurance is again a business where at a very high level, customer acquisition costs nominally are quite high, and margin profiles are such that payback periods are kind of long. So it's a business that has a very deep J curve. Like if you don't understand the concept as an entrepreneur, you should get acclimated to it very quickly. J curve is how quickly it's the shape of cash flow from acquisition of a customer to payback. And unfortunately, we have like a very sad and frustrating J curve. It's part of the journey. We know we were signing up for, but you know, note to all of you, like you should know going in what you're headed for, and like what your peers have raised is not always a good proxy for how much money you will have to raise. Like you should really understand the fundamentals of your business and what it implies in terms of capital efficiency and cash burn and what you have to raise. But no, we are hundreds of millions of dollars away from being done raising capital, sadly. So but it's like I talked about how it sucks, and I think we can all agree, like it's not the most fun experience, in part because you just like subject yourself to a lot of rejection over a short window of time, which is hard for humans to deal with generally. But it's also part of the job. Like we don't really get to complain about it, because it's not like you should walk into the business eyes wide open that, you know, depending on the business you run, this is part of your role. And in fact, if you're the CEO of an organization, in my opinion, you only have 3 jobs. One job is to make sure the company has like a North Star and they know what that vision is. The second is to make sure you are hiring and retaining the best talent possible. And the third is to make sure your company doesn't run out of money. So you hear me complaining about it, but on the other hand, like you don't really get to complain about it that loudly because it's in the job description. It's one of the only 3 things you have to do.
Great, thanks. Cool. I think we have time for one last question. So what are some pitfalls or mistakes that entrepreneurs can avoid when they're going through this process? And are there any types of capital that you guys would consider toxic, and how should they, know to avoid that?
So what your deck doesn't say is everything I'm going to ask questions around. So Kyle is very self-aware of what part of his business is sad, if you would say. Don't hide it. Have a plan and how you're going to approach it. Every business is hard. The executors of the hard can win big, but you got to have a strategy. So just not addressing it or not talking about it makes me feel, as I'm going through and trying to understand your business, that you don't have a plan. So hit it straight, be transparent, even if you're still working out, but you've got ideas around how to solve it. But don't hide stuff by omitting it, just talk through it.
Yeah, I would also say too, take your message and your story of the business. Make sure it's, as Kyle says, a very clear North Star to it, and that there's some ambition behind it. You know, we will sometimes talk to companies and ask them what they're using their capital for in this round, and they'll say, well, it's just to build out sales and marketing and keep doing what we're doing already. But I really, what I'm trying to get to is like, what's the ambition? What are we ultimately building to, over time? Because I think that's a really important aspect in all of this. And I do think that in success in fundraising is, as Kyle was mentioning, you're trying to find the one person that really believes in you. You're not trying to convince every single person. You're not trying to convince somebody that is not going to believe you to believe you. I think for every one time that works, it doesn't work 1,000 times. So I mean, the success rate is just very low. When you find that person that's leaning in really well, you want to make sure that you've built a structure and a process around it. You want to make sure that you are following up, that you've got all of the next steps identified, that you are continuing to move their process forward in some fashion, because sometimes opportunities just stall out. Sometimes they just lose momentum in the process. And I think it's very important to just, in a fundraising process, to keep that momentum relatively high with each of those parties that seem like they are genuinely interested in what you're doing.
2 things, practical things. I think I really like Patty's point. What I would say is we do this before every round, at least I do. Write down the things, like it should be a short list, 5 or 6 things that your investor has to believe in order to write a check, right? Like what are the 5 things your investor has to believe? And then you have to ask yourself 2 questions. One is, do I believe those things? Because if you don't believe those things, you're probably not ready to raise. What you don't want to do is go out and not be confident in those things that you have to have the confidence about your business to go and pitch it. The second is, am I hitting on those things, right? Because like your goal is ultimately to get the person who writes you a check to believe all of those things. You can't ignore them. So if like you walk into an investor's office and you hope they don't ask you about the fourth thing. You had better bet they're going to ask you about the fourth thing on the list, right? This is people, they're good at their job. This is what they do. So make that list, make sure you believe in it, and then make sure your pitch deck addresses you, like you feel confident you're going to get someone to believe those things, because that is your job. The second is do not underestimate how small the ecosystem is. And I would suggest when you're pitching, condense the time frame, because no's travel. So one thing that we learned the hard way as a company is, like, if you stretch out the fundraising process and you get a bunch of no's at the front end of the process, the next investor will hear about who told you no already. And that is not a good thing for you. So more practically speaking, like, I am a fan of more condensed fundraising processes, because it keeps the information flow a little bit tighter, and it gives you a bit of a leg up as an entrepreneur to try and avoid too many people sharing their thoughts on the business to each other.
Great. Thank you so much, Chris, Patty, and Kyle. I definitely think we got some great insights from you all on the fundraising process. Before we wrap up, I just want to do a quick overview about Michigan Central for the audience, so you can keep an eye out for what we have coming in the next year, and then we will wrap up. So very quickly, Michigan Central is the new mobility innovation district that Ford is building in Corktown, with the centerpiece being the historic Michigan Central train station, and then there's going to be several buildings around as well. This is not just a Ford campus. This is meant to be a place for startups, innovators, investors, big corporations to come work together to solve some of these biggest mobility challenges, because we know that they can't be solved alone. It's not going to be one company that's working on the future of EV or AV, et cetera. So we're really excited for this space to open. The spaces are going to be opening starting next year in June, July of next year for the first building, the book depository, and then closer to the end of the year for the train station. In the meantime, we've been hosting a number of events with the Bamboo team, and we've had a bunch of programming for the entrepreneur and innovation community, and so we would love for you all to stay in touch. These are some ways that you can reach us. Definitely, feel free to reach out if you have questions, ideas, etc. And we're also going to drop our website into the chat. So I'm really excited to see you all here today. Thank you so much for joining. And a huge shout out to Allison and the Bamboo team for making this happen. We couldn't do it without you. So thank you so much, everyone.
Thanks, everybody.
Thanks, Roshini. Thanks, everyone, for coming today. We really appreciate your time. As Roshini said, follow up on that Michigan Central website to keep an eye out on your inboxes, the website for our events happening next year. And please, again, show your appreciation for all the panelists in the chat. We appreciate you tuning in today. Have a wonderful evening.